And so this is Team 8, and my team consists of myself, Ying, Ming, Rachel, and Ting, and we will also present in this order. For question 1, the question asks that the manager will not have incentives to engage in earnings management if he or she believes in securities market efficiency. So to say that if a market is efficient, this means that at all times the share price of all publicly traded stocks will reflect all the public information. This means that returns are random and it will not be predictable. And this also assumes that investors will be able to see through the earnings management and be able to value the share accordingly. This means that investors will not be affected by earnings that have been managed. In this case, there will also be information symmetry, whereby no one party will have more information than the other party. However, we see that there are also other incentives for a manager to engage in earnings management. For example, under positive accounting theory, managers would want to have more bonus. So in the first point, we talk about managerial bonus points. Managers would have incentives to maximize their bonus and they prefer to receive bonus earlier. And this is according to bonus plan hypothesis. When the earnings is above cap, managers tend to manage earnings downwards because any increase in earnings will not result in more bonus. However, when earnings are below bogey, the manager will want to manage earnings downwards because no matter how much more effort is put in, earnings are unlikely to go above bogey. Whereas when in the case whereby the earnings is between bogey and the cap, then managers will try to manage earnings upwards in order to increase bonus. The second point is talks about covenants in lending agreements. The cost of violating debt covenants is high and this increases the cost of capital. So managers will be likely to engage in earnings management in order to avoid violating debt covenants. So violating debt covenants includes direct costs like higher interest rate and thus higher financing expense and also acceleration of payments. There will also be indirect costs in the sense of lower credit ratings and reduced ability to get funds in the future and loss of reputation. Generally, consistent earnings is usually perceived by investors to be more stable and less risky. Thereby, managers will want to smoothen income in order to increase investors' confidence. This will also lead to a higher chance of obtaining credit in future. For the third point, we also talk about political costs. Managers would want to manage income downwards in order to reduce political visibility due to high political costs. Reporting high earnings may create political heat and attract unwanted attention from the media, and this will result in regulations, boycott, or increased competition. Other incentives will include income taxation, whereby managers would want to manage income downwards to reduce tax expense for the current period. They will also want to smoothen the incomes in order to communicate that the firm is doing well and the firm has a strong earning power. In our last point, we also talk about how managers would want to engage in earnings management because they can hide behind poor disclosure to prevent the efficient market from detecting it. Next, we'll move on to question 2.
Thank you, Davina. So for question two is about BMS, a multinational pharmaceutical company in New York, which engaged in earnings management. And the two main earnings management devices they used are channel stuffing and cookie jar counting. So first, for channel stuffing, it is the practice of sending more goods to distributors than what they actually ordered. So BMS actually managed to persuade their wholesalers from accepting these excess inventories by offering to bear the carrying cost, which was millions of dollars per quarter. They then recognized this revenue on the excess goods, which helps to inflate the earnings and thereby meeting analyst forecasts. And as a result of this, they were fined 150 million by the SEC. And second, they also engaged in cookie jar accounting by creating fake reserves during periods of high profits and then using these reserves in low profit periods to smoothen their income. Next slide. Yeah, so for question 2A, we are supposed to explain why managers use such earnings management tactics. Next slide. So there are three main capital market incentives for managers. First, managers manage earnings in order to meet analyst expectations, which is mentioned in the case. Managers want to meet analysts' forecasts in order to prevent three main things: to prevent a negative stock price reaction, to prevent any loss in stakeholders' confidence, as investors might perceive the firm to have a bleak outlook if expectations are not met, and lastly, to prevent reputational damage. And second, managers also manage earnings in order to influence stock prices during important events like IPOs and mergers and acquisitions. By managing earnings, they are likely to raise more funds so that the firm will have greater ability for future expansion. And third, reported earnings can also affect stock prices. As seen in behavioral finance, investors have limited attention to process all available information. So they often focus on the bottom line of the company, such as earnings and EPS. Earnings are crucial for investors to assess a company's profitability and is a major factor in determining a company's stock price. Higher earnings will increase a company's EPS, and investors are likely to value that share more. So these are the three main capital market incentives. Yeah. So moving on, the positive accounting theory also helps to explain why earnings are managed, which Davina has covered in question one. So the three hypotheses are first, debt covenant hypothesis, which states that earnings are managed to prevent any technical defaults. And second, bonus plan hypothesis, which states that managers manage earnings either upwards or downwards depending on the bonus schemes to maximize their bonus for the current period. And third, political cost hypothesis, which states that earnings are shifted to future periods to minimize political costs such as regulations. So these are the main reasons why managers would employ earnings management tactics. And next time, we will continue with question 2B.
Thank you, Ying. So for question 2B, the question asks for us to actually evaluate the effectiveness of stuffing the channels as an earnings management device. So we have to consider both from the standpoint of a single year and over a series of years. So next. So in a single year, it is effective exactly because of IFRS 15, because revenue from the current period can only be recorded in the current period. So why is it so? Firstly, it helps to inflate sales in the current period and allows firm to meet analyst expectations and financial covenants. Secondly, it's unlikely to be detected by users of the financial statements, such as the investors and the creditors. Also, revenue shown in financial statements is an aggregate figure, not broken down by months or by the different product lines, and it is only possible to be detected through full disclosure and careful analysis, which most investors do not have access to. So the third point is that it is unlikely to be detected by regulators, because these contracts are actually mutual agreements between customers or the wholesalers itself. So only both these parties have the information. However, it is ineffective because of accrual reversal, exactly because of IFRS 15. Once goods are returned, the revenue recognized in this period will subsequently be reversed in this period's P&L when they are actually returned itself. And the second point is that additional costs incurred is actually covering the customer's carrying costs, such as giving discounts and such. Next. So for the series of years and future periods, it is totally ineffective, and we have 5 points to justify it. So the first point is the reduced sales and net income in future periods. So customers are actually likely to place smaller orders, if if any at all, in the next few periods, because they might be worried that BMS might actually send excess products to them. To prevent this from happening, they place smaller orders. And two, physical limitations of wholesalers and customers. So wholesalers may actually run out of storage space in the long run due to lack of space or fall in consumer demand, because that would actually increase their inventory turnover, which is actually bad for them, and they are unable to accept excess inventories in the future years. So number three is the increased bad debt expense. So the amount of goods delivered might be outside of the customer's ability to pay. For example, they might only be able to pay for 200 of the goods, but 300 is sent, and this might cause the wholesaler or the customer to not pay them according to the schedule or according to the contract itself. And the fourth point is that it impedes long-term visibility of the firm. So it's actually financially unsustainable for firm to bear shipping costs and continually offer deep discounts in the long run. and the firm's cash flow might actually be adversely affected because this actually decreases the profit margin of each inventory or each of the stock that is sold to the customer or wholesaler. And for point number 5, it actually attracts the attention of regulators because the continual employment of such methods with high customer returns will create a large number of adjustments being required every year, and this will raise auditors and regulators' suspicion. Next. So in conclusion, yes, it is effective in the short run, and earnings will only be boosted temporarily. However, it is clear that it is ineffective in the long run because it will inevitably lead to a collapse such as Enron or even BMS. And it's also very important for a company to set realistic sales targets that they can meet. So thank you.
Hi, okay, so I'll move on to question 2C, which talks about why with the effectiveness of the cookie jar accounting and earnings management device and what earnings management pattern did VMS appear to be following by means of this tactic. Next. So VMS actually appears to be following income smoothly to manage its earnings. This is achieved by shifting revenue and expenses across different reporting periods and is typically to increase earnings in periods with unusually low earnings. The goal of this tactic is to reduce fluctuations in earnings from one period to the next. Next. One pro of this income smoothing is that it prevents negative stock price reactions through increasing profits in the low profit period to meet expectations of investors and analysts. The firm is also perceived as less risky by investors, as investors actually prefer a stable pattern of earnings, which indicates a consistent performance by the firm. Lastly, this tactic is also hard to detect as compared to channel stuffing since there is no accrual reversal. Next. On the other hand, one con is that this does not fully reflect the firm's financials for the period. This may actually mislead investors into perceiving that the firm is actually doing well, when in actual fact, it actually failed to meet the earnings target. Another con is that this tactic is not sustainable in the long run, as if the firm continually misses its earnings target. Eventually, the cookie jar will run out and the firm is unable to replenish the cookie jar. Lastly, as investors and analysts' expectations grow over time, it becomes more difficult for the firm to meet the expected profits. The firm then has to look for other earnings management methods, which eventually results in a vicious cycle. So now I'll pass time on to Ting, who will go through question 3.
Moving on to question 3. A reason for the creation of OCI is that management objects to the inclusion of certain items in the P&L on the grounds that they are volatile, uncontrollable, and uninformative about their effort. There is the feeling that OCI has become a dumping ground for anything controversial because of a lack of definition of what should be included in it. Next. Part 3A, we discuss whether the creation of OCI is most consistent with the public interest or the interest group theory of regulation if ultimately the goal of standard setters is to value all assets and liabilities at fair value. Next. First, we look at the public interest theory of regulation. According to this theory, IFRS standards are created to correct market failure and maximize social welfare. Hence, by creating the OCI to include items that are not categorized into P&L, this increases the transparency, accountability, and efficiency in the market. Next. According to the interest group theory, regulators act in accordance to various interest groups which are self-interested. In this case, the manager's interest is to maximize as they can control what goes into P&L and the OCI. By separating the unrealized gains and losses, which are more volatile from net income into OCI, this fulfills manager's desire to reflect less volatile net income into investors. Hence, given the volatility nature of the OCI items, we conclude that the nature of OCI is most consistent with the interest group theory of regulation. Next. For part 3B, states that a company can present OCI together with P&L or separate statement from P&L. For this question, we are discussing if manager feels strongly that company should present OCI separate from P&L statement. Is it consistent with manager acceptance of efficient securities market theory?
Under efficient securities market theory, share price of all publicly traded stock fully reflects all public information at all times, and investors would be able to respond to all public information. For P&L and OCI, both are considered as public information regardless of whether OCI is separated from P&L statement or not, and the valuation of share price will remain the same. Next. The manager, by wanting to separate OCI from P&L statement, believed that OCI can be a dumping ground and information can be hidden in OCI. Therefore, manager's strong views of separating OCI from P&L is not consistent with his acceptance of efficient market theory. And with that, we have come to the end of our presentation. Thank you for listening.